Yes, so hello and welcome everyone. Today's lecture on law of accounting for using on focusing on understanding company and insolvency law. So in learning outcomes too, we will delve into the formation, financing, and administration of companies. So learning outcome to indicative contents for this lecture, including discussion on procedure for companies and limited liabilities, partnership, registration, including the memorandum, article of association. I hopefully both of you know about these terms because they are very most important terms when if you have if you already studied mercantile law, business law, in your bachelor degree or in your ACCA qualification. So, and also, I hope you know very well about Companies Law 2006 as well. So we will discuss about advantage and disadvantages of company laws, limited liability partnership, compared to partnership, sole trader, other legal structures, veil of incorporations. So, directors, officers, and shareholders, insolvency. So, terminology. What company is? Uh, a company is a legal entity which has a legal personality separate to those who own or run it on a day-to-day basis. Company's separate legal entity, for example, separate from its shareholders, the part owners, and its directors, the managers. Right, veil of incorporation and what it can be lifted. So nationality in terms of war, sorry, yeah. So, in terms of times of war, it is illegal to trade with the enemy. It may be, possible lift the veil of incorporation as so as to impute to a company the same nationality as its member. So here's that case law. Uh, so veil of incorporation, it can be lifted. The concept of the veil of incorporation emphasizing the legal separation between the company and its shareholders and directors. In certain circumstances, the veil of incorporation can be lifted, allowing the company's legal personality to be imputed with the same nationality as its members. An example is providing, through the Daimler and Continental Tires and Rubber Company case 1916, where effective control of UK incorporated company by individuals with an enemy nationality led to the lifting of the veil, preventing debt discharge to the company in wartime due to the implication of trading with the enemy. Types of company, yes. Any comments from you guys? Can you hear me? Can you see my screen? Can you hear me? Hi, Andrea.
Yes, I can hear you. No questions.
Okay. Welcome, Andrea. Are you okay?
Thank you. Thank you. Sorry, I was a bit late. Sorry.
No.
I had to do.
So,
I had a few things
any
to do.
comments, or if you can explain about public or private company? Anyone can, any comments? Anybody knows about private company? Harnish? Hanish?
Private company is an organization that has shareholdings or members who are a small unit, or not necessarily a small unit, but they only have ownership within a group of people. within their domain, whilst a public company is being able to have membership on a larger scale and is offered to the rest of the population on a national level.
That's
And they can buy and sell shares on the stock market.
yes. So basically, that here you can see some difference between public and private companies, but I'll go through, quickly. So private company versus public company, the concept of private company and public companies discussed here. Private companies are distinguished by its limited number of shareholders, okay? And its shares are not available for public trading. In contrast, public company can have an unlimited numbers of shareholders, and its shareholders are traded on the stock exchange. Am I right? Any so ends with the name, ends public company with a PLC or public limited with the limited company, private company. Capital must not less than authorized minimum, that 50,000 pound, and in order to trade must have allotted shares of at least that amount, no minimum or maximum requirements. Then raising capital. Public companies may raise capital by advertising its securities, shares, and debentures as available for public subscriptions. But in case of private company, not allowed from offering its securities to the public. Start of trading, must obtain trading certificates from the registrar before commencing trading, and can begins from date of incorporations. And directors, minimum 2 directors, and private company minimum 1 company. So private company versus public. Secretary must have 1 secretary, need no one. Accounts must be audited, no audit required. Okay, but may lay accounts before general meeting, must file within 9 months. Audit must file account within 6 months. No audit required if turnovers below 6.5 million. So annual general meeting must be held each year and need no held on AGM or annual general meeting. So can't pass written resolution in case of public companies, but private companies can pass written resolutions. Yes, so consequences of incorporation, consequences of a company. There are a number of consequences of being a separate legal entity. So being recognized as a separate legal entity, these include limited liability. Shareholders are only liable for unpaid share capital or agreed contribution in the case of company failures. Contractual capacity, a company can enter contracts in its own name, sue and be sued independently. Ownership of property. So the company, owns its property. Perpetual succession. The company continues to exist irrespective of changes in shareholders. Then separation of management and owners, distinct roles for management and ownership, compliance with Companies Act 2006, are subject to the regulations outlined in the Companies Act 2006. So what is the rule of force versus horizontal? Starting that when a company suffers an injury, it is the company itself that must take remedial action. The rule more broadly asserts that individual shareholders cannot sue for wrongdoing to the company or complain about internal irregulations or irregularities. What is company law? Can you guys see my screen and can you hear me? Any issues?
No issues.
Okay.
All good, thanks.
Okay, so the definition of company law is presented as the legal framework governing the creating and operation of registered companies. So the focal point in the Companies Act 2006, which comprises numerous sections and schedules. The nature of company law, it statutory basis and certain aspects remaining as, case stated law are highlighted. So the mention of remedies for breach of directors' duties and the enduring relevance of interpretations of past Companies Act in legal proceeding add, uh, 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 to the depth to the understanding of company law. Company laws, securities. Here, company laws includes part of securities regulation and insolvency law. So, company law, securities and regulations, insolvency law. Company law encompasses elements of both securities regulations and insolvency law as they apply to companies' securities regulation, a subset of capital markets or financial services law. Deals with the rules governing financial instruments and transactions, especially those involving securities. So, similarly, insolvency law focuses on the legal process related to financially distressed companies. Over the past few decades, both securities regulations and insolvency law have evolved into complex legal subjects in their own rights. Here he's talking about corporate governance, while not a strictly legal term, serves as a framework under which questions regarding how, by whom, and to what and corporate decisions are made are analyzed and reflected upon. So the terms encompasses the principles and practices guiding the decision making process with a company. So, core company law and corporate governance overlap significantly, as many aspects of core company law establish rules and principle, defining how and by whom corporate decisions may lawfully or legally, be made. A various source of companies law, various acts governing law for companies, Companies Act 2006, Financial Services and Market Acts 2000, Insolvency Law Act 1986, Criminal Justice Act 1993, Inside Dealing or Inside Trading, Companies Director Disqualification Act 1986, Companies Act 1985, Company Investigations. So, companies, audit investigations, and community enterprises Act 2004, company investigations and community interest companies, CICS. So, analyze the requirement of company law for the formation, financing, and administration of companies. Uh, Formation, financing, and administration of companies. When considering the requirement of company law for the formation, financing, and administration of companies, it is crucial to recognize the diverse type of companies. Among them, the private company limited by share stand out as the most common in the UK. So the formation of a company, whether a limited liability company, LLC, or a private limited company, PLC, provide distinct advantages, notably the separation of liabilities between owners, directors, and company itself. This limited personal exposure to creditors and legal actions against the business is a compelling reason to choose the company structure. In a sense, forming a company is a strategic choice that shields owner and directors from certain liabilities, differentiating it from other businesses structures like single ownership or sole trader or partnership. The legal framework supported by various acts lays the foundation for understanding and navigating the complexities of company law in the UK. Advantages of forming a company. So, forming a company brings several advantages. Firstly, it may ease the process of raising finance, making it more attractive to potential investors. Uh, Additionally, the company structure allow for the formalization, uh, ownership, and voting arrangements among individuals involved in the business. From a legal and administrative perspective, forming a company provides the benefits of comprehensive governance under one umbrella, the Companies Act 2006. Advantage to how advantage to forming a company. Forming a company brings as I said several. This one is done. Sorry. So how to form a company? Sorry. So a company is formed by filing a series of documents with the registrar of companies and companies house, part of the Department for Business Innovation and Skills. So, basically formation of a company involves filling specific documents with the registrar of companies at company's house, a part of the Department for Business Innovation and Skills. So this process guided by the Companies Act, uh, and they get certificate of incorporation officially establishing the company. Key documents include, if it's here, INO1 form, documents including form which requires certain basic company information be provided, such as the company name, who the initial directors and company secretary will be, and who the shareholders of the company will be. Also, the memorandum of association and the articles of association. Things to consider, several considerations come into play when forming a company. The company name must adhere to specific rules, such as ending with limited for private companies, ensuring a unique name, and avoiding sensitive or offensive words is crucial. It is also, essential to check for trademark infringement. Companies can change their names through a special resolution or other means outlined in the articles. Shareholders and share capitals. One of the notable advantage of forming a company is the ability to formalize the ownership structure through shareholdings. A company must have at least, as we discussed above, one shareholders holding at least one share. So there are no restriction on the number of shares or their denominations. Considering multiple classes of shares allows for different rights, making it especially useful for attracting private investment. Any question?
No.
Okay.
Not
Okay.
So directors, the board of directors plays a vital role in the day-to-day management of a company. When forming a company, consideration includes the minimum number of directors, usually two, and the absence of a maximum limited director qualifications, and the advisability of obtaining directors and officers insurance to protect against potential crime. So there are some other things when they choose directors, like must be at least 16 years old. English law does not have any nationality or residence requirement in respect of directors. So, and officers insurance in place, as I said, protect directors for claims for wrongdoing that could be, personally liable, or, insurance to protect against potential crime. Appointing a secretary, while no longer, mandatory for private companies. Okay, so remains an options. So the secretary who can be director or another individual's company carries, or you heard about company secretary or corporate secretary out significant duties, including maintaining minute books and registers. Despite the imposed duties, having a secretary can be beneficial to ensure compliance with the Companies Act and meet administrative requirements. Registered office, when forming a company, specifying the registered office is important step. This address, located in England or Wales, serves as the official location for legal services and document delivery. Importantly, it does not necessarily have to be the primary place of business. Changing the registered office is very straightforward and can be done through a board resolutions and submission of a form to company house. Constitutional documents. When we talk about constitutional documents upon incorporation, two key constitutional documents are required. The memorandum of association and article of association. So any comments? Anybody knows about association and memorandum of association or and article of association? Have you heard before about
I have, yes.
both documents? Yes, Hanesh.
Yeah, but both of them, one of them defines, as it says, it's just a formality of
Yes.
the listed subscribers, members, and the other one states what the regulation,
Yeah,
how
basically,
their behavior.
yes, that's correct. The memorandum simply declares the intent of initial subscribers to form a company under the Companies Act and become members. On the other hand, the article of association, when we talk about, article of association, act as a contractual framework between the company and its shareholders, regulating various aspects like, dividends, directors, appointments, removals, shares transfers, and the conduct of meetings. Okay. So article of association often incorporate the statutory model article provided by the Company Act. So these model articles are automatically adopted if a company does not submit any other article of association. Considering the wide range of applications, articles of associations can cover crucial subjects like voting rights, dividend distributions, termination of directorships, and share sales. So this flexibility is especially significant when accommodating the needs of equity investors or determining membership arrangements. Sorry. So uh, analyze the role and responsibilities of company directors, officers, and shareholders. Roles and responsibilities of directors and shareholders. The Company Act, 2006 outlines specific, duties for directors of UK limited companies. Directors play a very important role as the governing body responsible for managing the company's business. They make crucial decisions, ensuring strategic and operational success while meeting statutory obligations. Directors act as agents appointed by shareholders, collectively making decisions in board meetings. Delegations of powers to individual directors or committees is very common. So, as a director, your role involves active participation in board meetings to contribute to decision making and fulfill the company obligations. Directors may be, shareholders or employees carrying additional rights and duties beyond their, directorial responsibilities. So this multifaceted role emphasizes the collaborative nature of corporate governance, where shareholders and directors work together to steer the company towards success. When we talk about general duties of directors, there are many general responsibilities. Indirect responsibilities and direct responsibilities includes. So company directors, have various responsibilities, both direct and indirect, in ensuring the smooth functioning of the company. Direct responsibilities include acting with their powers, promoting the success of the company, exercising independent judgment, maintaining reasonable care, skills, and diligence, avoiding conflict of interest, not accepting benefit from third parties, and declaring interest in proposed transactions. So when we talk about indirect responsibilities, often handled by accountants. So involve tasks like registering for business tax, filling annual statements and accounts, and reporting company changes. So company director, personal liability of company directors. Company directors can be held personally liable for acts or omissions committed during their tenure. So this liability encompasses a range of offenses, including unlawful discriminations, uh, uh, workers' pension, health and safety violations, environmental breaches, corporate manslaughters, and willful, ignorance of fraud, bribery, money laundering. Exceptional cases, directors may face disqualification for up to 15 years, and potential imprisonment for serious offenses. Duties of shareholders also play a very important role as the financial supporters of a company. Their rights include attending general meetings and voting, receiving a share of the company's profits, obtaining specific documents, inspecting statutory books, and claiming a final distribution in the event of the company's winding up. So the main duty of shareholders is a past resolution at general meetings, exercising ultimate control over the company and its management. Also, duties of shareholders can vote either on a show of hands or through a poll vote, with each vote, proportionate to the number of share held. Ordinary resolutions require simple majority more than 50% of votes in favor, typically done through a shows of hand. Special resolution needed for crucial matter like changing the article of association, demand 70% majority votes in 7% majority votes in favor. Explain the process of insolvency for business organization. Process of insolvency for business organization companies, despite their potential to continue indefinitely, often face dissolution due to financial unviability, or the process leading to the end of a company operations, known as winding up or liquidation. so more common known as liquidation, involves selling assets to pay off debts. Even solvent companies that can fully pay their debts go through a winding up process governed by Insolvency Act 1986. Yeah. So this legal framework ensures a systematic and lawful conclusion to companies' existence, addressing financial obligations before dissolution. So insolvent companies, the inclusion of insolvent winding up within the Insolvency Act 1986 alongside insolvent winding up was a strategic move. They streamlined the legal framework. Most winding ups involve insolvent companies and consolidating both types of winding up provisions in a single statute. So rather than duplicating them in the Companies Act 1985, yeah, 1985. Now the replaced by the Companies Act 2006. So and the Insolvency Act 1986. So proved efficient in the UK. It's a crucial to note that the term insolvency applies to both companies and individuals, whereas bankruptcy specifically refers to the insolvency of individuals, not companies. When winding up a company, a statutory orders of a distributions dictates the priority of payments for different type of creditors. Insolvency and administration. Uh, Insolvency law is a nuanced and specialized field that involves intricate process. The primary formal process integral to insolvency law or administration are designed to rescue financially troubled companies and liquidation, the winding up process. Through these processes, administration and liquidators possess various, powers, including the liability to bring legal actions and review and challenge certain transactions entered into the company. Securities regulations law aims to safeguard individual who invest their money in various investment uh, products. So encompassing those unrelated to companies, securities regulations is subset of financial law, which comprises banking law, the regulations of investment business, conduct and market, and the regulation of companies whose securities are publicly offered. So securities regulations in primarily relevant to companies with shares or bonds listed on stock exchange, emphasizing the protecting of investors in these traded securities. Global financial crisis of 2008. I hope anyone knows about the global crisis 2008. The reforms of UK laws in response to the 2008 global financial crisis resulted from both UK and EU initiatives. Significant changes were made, particularly in the regulations of bank and the realignment of regulatory responsibilities. So the Financial Services Act 2012 played a important role in this realignment of, abolishing the Financial Services Authority and establishing two regulatory body. We were talking about yesterday, Harnesh. Uh,
Yeah, FC and PRA.
The Prudential Regulation, which we talk about, which is a subsidiary of the Bank of England, and the Financial Conduct. As I said, that name is changed, so now is FCA. So under the umbrella body Financial Policy Committee, while the FCA underwent name change and refocus, the framework of securities regulations remained amendments highlights the reliances of the regulatory structure in response of, in response to financial crisis. So the Financial Services and Market Act 2006, as amended most recently by the Financial Services Act 2012. So the cornerstones of security regulation in the UK remains the Financial Services and Market Acts (FCMA), bolstered by amendments most recently by the Financial Services Act 2012, the Financial Services and Market Acts 2000 impose the primary security regulations to establish details, provisions encapsulated in the Financial Conduct Authority handbook. This regulatory framework uh, this regulatory framework is complemented by a soft law exemplified by the UK Corporate Governance Code and Stewardship Code. So there is another advice on the insolvency process of a given situations. So basically, this is a completely that legal scenario or legal process. So insolvency defined as an inability to pay debts occur when a company lacks assets to lack of assets to cover liabilities or can't meet debt obligations as they fall due. So various factors such as market shifts, management failures, then frauds, financial mismanagement, and loss of long-term finance can, lead to insolvency or liquidations. Case studies scenario. Here, use of hypothetical scenario involving a local supplier, client C facing non-payment from a manufacturing company, which is D. So due to cash flow problems, professional advice is sought actions under insolvency law and the process to obtain an effective final order against the debtors are crucial consideration in addressing apparent insolvency. Uh, Analyze aspect of capital maintenance. The concept of capital maintenance asserts that profit recognition should occur only if a business maintain its net assets during an accounting period. So profit is essentially the increase in net asset. The concept excludes certain cash flow impacting net assets such as stock sale to shareholders and payment of dividends. Inflation can skew this concept, so emphasizing the importance of adjusting for inflation in assessing capital maintenance, particularly in a hyperinflationary environment. Any questions so far? Any concerns, issues?
All good.
Okay, so the concept of capital maintenance focuses on the net changes in account balances during an accounting period, not on the physical maintenance of a business assets in a limited company. Share capital is seen as buffer fund for creditors. It is essential to note that this creditors buffer is an accounting fund, not actual money. So the cash or assets subscribed can be utilized by the company. The rules on capital maintenance are in place to prevent a company from reducing its capital by returning it to its members either directly or indirectly. Generally, a limited company is not allowed to reduce its share capital. However, an exception to this general rule. So under section 641, under section 641 Company Act 2006, a company has the flexibility to reduce its capital at any time and for any reason. This reduction can, take various forms: reduce or cancel liabilities on partially paid shares. Uh, the company relinquishes any claim for money owned at these shares, then return capital in excess of the company's needs. The company reduces its assets by repaying cash to its shareholders. Then, the cancel the paid by capital that is no longer represented by the assets. So if the company basically, has a debts balance on reserves, it can write off this balance by reducing capital, eliminating the need to make good past losses. So these provisions under section, section 641, 641 Company Act 2006, uh, offer a legal framework for companies to make adjustments to their capital structure as needed, providing flexibility in managing their financial affairs. Procedure for public companies, public companies here. So procedure for public companies follows a distinct procedures. Uh, Here is detail of the these procedures. Pass a special resolution, apply the court of confirm the special resolution. Reduction involves one of the first two methods above. Court must requires company to settle list of creditors entitled to objects. Also, court must not confirm the reduction until it is satisfied that all creditors have either consented to the reduction or had their debts discharged or secured. The company must file documents while the registrar if the shares capital of a public company falls below £50,000, it must re-register as a private company. So procedure for a private company follow a distinct procedures. The detail of procedure is like pass a special resolution. Solvency statement is a statement of each of the directors that the company will be able to meet its debts within the following year. Then solvency statement made without reasonable grounds is an offense punishable by fine and or imprisonment. Copies of the resolutions, statements, and a statement of capital must be filed with the registrar within 2 weeks or 15 days. So some additional information, treasury shares definition and general rules. Treasury shares basically created when a public company repurchases its own shares, don't necessarily have to be cancelled. The company can hold up to 10% of the shares in treasury, facilitating reinsurance insurance without the usual formalities, while the general rule is to cancel purchased shares and reduce the shares capital account. There are exceptions for companies listed on the stock market or the alternative investment market. So such companies can buy, hold, and resell their shares without canceling them. So the shares, if cancelled, requires no special resolution of court, authorizations. Here are some, exceptions under section 724 Company Acts 2006. Listed companies can buy and sell qualifying shares from distributable profits. These shares do not grant voting rights and not divided, dividends or distributions can be made in respect of them. if cancelled, a reduction in capital occurs without the needs for special resolutions or court authorizations. Section yes, section 730. Let's see here. Yeah. So Company Acts 2006 2006 mandates that the company must deliver a return to the registrar within 28 days. So within 8 days after cancelling treasury shares, detailing the number, nominal values and date of cancellation for each class. So some final words for additional information. The notice submitted for cancelled treasury shares must include a statement of capital, providing comprehensive details about the company's share capital immediately following the cancellation. This include the total number and nominal value of shares, prescribed particulars of rights attached to shares. So the amount paid up and the amount unpaid on each shares, treasury shares, can also be created initially when a company issues shares to the public, but retains a portion in its treasury for later, sale. So that's it for today. Some references here and websites and books are mentioned if you wanna. So also here you can see that assignment submission is 2 weeks after completion of the units and its delivery. So that's it for today. Any questions, any concerns or issues? Anyone else?
Not so far, but this coming week I will go through it all, and maybe next week there will be more questions.
Yeah, no
etc.
problem. Thank you very much, everyone.
Okay.
And
Thank you.
thank you very much, everyone, and have a good day ahead. And
Thank
see
you.
you next Saturday, 2 o'clock. Okay.
Great.
So
Okay.
if
Thank
you have
you.
any question, concerns, or issues, drop me an email at yasir@ukversity.co.uk, or I think so there is a group as well. So you can discuss any kind of issues or concerns. Thank you very much, everyone,
Thank
and
you.
see you
Bye-bye.
Thank you.
Okay.
Thank you.
Bye.
Bye, everyone.
Bye-bye. Bye.